Hello everyone, how are you? Yeah, back to this channel where we are going to discuss today we are going to discuss about ACCA paper strategic business reporting. Okay, I hope and I wish that if once the class is complete, then please subscribe this channel, like this channel, and share these videos with all those people who are expecting and who are writing the ACCA exam with respect to strategic business reporting. And apart from that, you can have the class videos on F8 audit and assurance and F7 financial reporting on my channel, on my YouTube channel, Dr. Labib Academy. Okay, please share it and like it. Okay, subscribe it to my channel, please. Yeah, coming back to this, what we are going to do today, is it right? Today we are going to talk about something specifically with respect to the consolidation of financial statements. Is it right? A compulsory question for almost 30 marks. In this we are going to cover today is, what is the date? Today is 7th of Feb. Is it right? Today is 7th of Feb 2023 as such. Fine. It will take, you say, we are going to have a detailed discussion, we are going to have a detailed analysis of the solution as such. Okay, what they are asking us, that this question is right, this little bit it makes sense, is it right? This question requires the preparation of consolidated statement of financial position. What the examination team have said, that the preparation of full consolidated statement is unlikely. What they are doing, they are talking about the part of segments, is right, concepts to appear in the exam. However, this question provides a revision of a range of issues. We are going to talk about the consolidation issues with respect to consolidation of financial statement. So the first thing, see, this is the way, see, you have to know the techniques, you have to know the way we have to approach the examination. Is it right? That's very simple. And first and foremost, what we have to do, we have to make sure that what are the requirements. Any question paper, any exam, is it right? Any exam we are going to see, then the first is we have to know what is the requirement. The requirement says that there should be a consolidated statement of financial position for a traveler group. So for the year, and here the date is very, very important, 30th of November 2001. How many marks they have allocated? They have allocated for 23 marks. Okay, this is the first step. Now coming to that, what is the second question that they are talking about? The second question, there in the second part B, is it right? They gave you a scenario and they are saying that whether discuss that proposal is in accordance with IFRS standards. They are given something with respect to what? They are something with respect to inventory. At the start of the year, acquired major subsidiary with respect to a business combination. Business combination is nothing but IFRS 3 as such. Is that with respect to fair value? This year here again, business combination is IFRS 3. Okay, they are talking about the inventory valuation. Is that how it has to be accounted and how it has to be recorded? Is it right? This we will do. How many marks they have given? They have given it for 7 marks. Is it? This is what the first and foremost thing that should be taken into consideration is what are the requirements. Is that what it is required? Then we can focus on that. The first 15 minutes of reading time, just you have to take into consideration the requirements and subsequently that. Now coming back to this, very specific and very clear. Is it right? What they are saying that the Traveler, a public limited company, operates in a manufacturing sector. The draft of statements of financial position. They have a Traveler. There are two subsidiaries. Is that one is data and one is captive. Is it? Now they have given current assets, property, plant, equipment, investment in subsidiaries. Is it right? How much is in the data? 820. And how much is in the captive? 541. They have financial assets. Fine, okay. Is it? This is the total of financial assets as such. Is it? This is the total of financial assets as such. Is it right? And you have the total assets. The share capital is there, retained earnings is there, other component. This is the first thing. Somewhat we have. What are the other components of equity? Is it 60, 37, and 45? And you have total equity, non-current liabilities, and subsequently you have the current liabilities. Fine. Now coming to the basics. Okay, what they are making it clear. See what we have to do. The first thing we have to do is that we have to know what is the structure of the parent company, how they are taking into consideration the percentage of investment. That is the first note. Is it? On 1st of December 2010, Traveler acquired how much? 60% of the equity in data, a public limited company. Fine. The purchase consideration is 600 at acquisition, at the date of acquisition. This is what we need, is it right? The fair value of NCI is how much? 395. We use the data in so many workings. Okay, in so many different step working notes we are going to do that. Traveler wishes to use IR. This is you have a full goodwill, is it right? You have a full goodwill method. When you are talking about the full goodwill method, is it right? It is recognized in a business combination for NCI as well as for the parent company. Is it full goodwill? There are two methods as per IFRS 3 business combination. We are going to discuss about the partial goodwill method and a full goodwill method. In the full goodwill method, we are taking into consideration both the subsidiary as well as the parent company, whereas we'll come to that. Is that full goodwill method? They gave you the information. What are the identifiable net assets? Is that what are the identifiable net assets acquired is this much. They have given the retained earnings and other components of equity. The excess in the fair value is due to non-depreciable land. Whatever the difference, is it right? Whatever the difference is going to be identified as the value of the land asset. Is it as the value of land asset? Whatever the things it is going to be, 935 million. Is it right? 935 million is identifiable assets are 935, and whatever the difference is the non-depreciable land. On 30th November, see the thing, December 1st, they are acquired with how much? 60%. Okay, with 60%. On 30th November, okay, on 30th November 2001, they have increased the share. Is that 20% increase further required? Means what will happen here? The parent company share, is it right? The parent company share will increase, whereas the NCI will decrease. Is it right? The NCI will decrease. Is it? For a cash consideration of how much? 220 million. Yeah, 2001. Okay, November 30th November 2001. This is the first point. Okay, it's very easy. It's not difficult. Is it? Now, what it says in the second point, Traveler acquired 80%. Is it right? Means in another company, captive, for a consideration of 541. The consideration is they gave cash of 477, and the transfer of non-depreciable land is how much? 64 million. Is it? That means there is a non-depreciable land of The carrying amount of land at the date of acquisition is 56 million. Fine. The carrying amount. At the year end, this asset still included in the non-current assets of the traveler, and the sale proceeds has been credited to profit and loss. Means they have not excluded this asset. This asset has been still in the financial statement. Means we have to reverse this entry as such. Okay. That's the most important thing. We have, see, this is the addition, is it right? They will test us how we are focusing on that specific point or not. At the date of acquisition, what is that they gave this thing? This will be need, okay? For the fair value is 2526, retained earnings 90, other components of 24 million. Here also the same rule applies. Anything excess in value is going to be accounted for the value of the land. This acquisition is using, see the things, in the first method, we are using, in the first case, we are using the full goodwill method. In the second case, we are using the partial goodwill method in accordance with IFRS 3 combination. Okay. This one we have to be a little bit careful about that. Is that how we have to be accounted for the full goodwill and how we have to account for the partial. In the partial goodwill, what is the basic concept in the partial goodwill? In the partial, only parent share of the goodwill is recognized. Is it right? Only the parent share of the goodwill is. Now, what is they have said that there is a goodwill. Point number 3, goodwill was impairment tested on 30th November. The recoverable amount of assets of goodwill is 1099 and this 700 million for the captive. This we will take into consideration while doing the calculation of the impairment of goodwill. Fine. This much is the things. Now we are covering, we are making it a point how we have to structure our answer. Is it right? Now the first thing is that we'll go by workings. Okay. First we will do the workings as such. Is that we will do the workings as such. Yeah. Note 1. Is it right? Note 1. What is the note 1? You have a traveler. Is it right? You have it. This is the This is the parent company. Okay, traveler is the parent company. They are acquiring. Okay, they are acquiring. One, they are acquiring with respect to the data. Is it? One is referring to the data, and the second one is with respect to the captive. Is it right? What is that? They have acquired 60%. Is it right? 60% on December 2010. Is it right? Till 30th of November 2011. Is it right? Next. And how much they have increased? They have increased by 20%. Means how much is there? 80%. This happens when this happens on November 11. Is it right? This is related to the information with respect to the data. Is it? This is required. Whereas in terms of captive nothing is there. Is it 80%? Is it? They acquired 80% on 1st of December 10, and this is going to be remain till 2021. Okay, this is with respect to the captive. But this is most important thing. Yeah? This is where it makes the difference. Now, is it right? Now, then what is the second one? Second one we have to know. Is it right? What are the assets? Is it right? What are the net assets? What are the net assets with respect to note 2? Is it note 2? Note 2 says about the net assets. Is it net assets? Is it what is the net assets at the date of acquisition? Is it what is the net assets at the date of acquisition, and what is the date? How much is the date of acquisition, and how much is at the reporting date? Is it right? How much is at the reporting date is nothing but the one which has been given in the balance sheet. Is it right? At the date of acquisition is nothing but what is given in the at the time of on the date when it has been acquired in the point number 1. Okay, first we will take into the things with respect to what, with respect to data. Okay, with respect to company data. Is it put very clearly particulars? Is it right? Particulars at the acquisition date, and at the reporting date. Is it at the acquisition date and at the reporting date? Fine. If you have any doubts, anything either, you can post it on the comment section, and if you want any particular question to be going to be discussed, just put it in the comment section. I will get back to you with that video as sooner as possible. Is that on priority basis? Now what they say, they are saying about the share capital. Is that of the share capital of the data? Is that how much is the acquisition date? See the thing, how much is they have the equity interest of data public. The purchase consideration is 600 million. At acquisition, the fair value of the NCI is how much? The fair value of NCI is how much? 395. Is it right? Next, the fair value is 395. Traveler wishes to full goodwill method. The retained earnings are how much? The retained earnings are 299. The other components of equity is how much? The other component of equity is 26, and the excess in the fair value is, when we take the things, the share capital is how much? The share capital is 600. Put it in millions. Okay, put it in millions. All the calculations will be in millions throughout the case. Share capital is how much? 600. Next, we are at the date of acquisition. Is it right? At the date of acquisition, how much is the retained earnings? The retained earnings are how much? 299. Okay, the retained earnings are how much? Retained earnings. Retained earnings is 299. Okay, you have other components of equity. Is it right? Other components of equity. Other components of equity is how much? They have mentioned here. Is that everywhere, wherever is there, I will just putting the things. Is right? Other components of equity is how much? 26. Fine. Now how much they have? Total value is how much? Fair value of NCI is how much? Fair value of NCI is how much? They have given 935. Is it right? Fair value of NCI is 935. There will be a balancing figure. Is it right? Balancing figure. What is the balancing figure? They said that here they have mentioned the excess. Is that balancing figure is nothing but the excess. Excess is going to be identified as a land. If you take 600 plus 299, is that 600? How much is that? 935. 935 minus 600 minus 299 minus 26. Is it right? Minus 26. It comes to how much? 10. Okay. This is the value of the land. Fine. At the reporting date, that's very simple, isn't it? At the reporting date, how much is for the data? Data is how much? 600 is the equity, 442 is the retained earnings, 37 is the other components of equity, is the other components of equity, and the same thing we are going to carry forward with respect to what? With respect to the land, it is going to be 10, is it right? If you take all the things into consideration, it comes to how much? 2 plus 7, 9, 4 plus 3, 7, 8, 6 plus 4, 10. This belongs to this only. Now, how much is what is the net asset movement? Is it right? What is the net asset movement? Is that net asset movement is how much? Reporting date. Is that reporting date? Reporting date is how much? Reporting date is 1089. And on the acquisition date is how much? Acquisition date is 935. Is it right? 935. How much? What is the difference? Difference is 154 million. Is it 154 million? This 150 more million is nothing but the net assets movement. Okay, we'll take this net assets movement next. Now, what are the other components of equity? How much is the other components of equity? Other components of equity difference is how much? 11. Is it right? Other components of equity is how much? The difference in other component of equity. Difference in other component of equity. Is it right? Reporting date is how much? Reporting date is 37, and on the acquisition date, is it? On the acquisition date it is 26. How much is the 11? Is it right? The difference between the net asset movement and the other components is it relates to retained earnings. Is it? The difference between, is it right? Difference between, what is the net difference between net asset movement? Is it right? Net asset movement is how much? Net asset movement is 154 million. Okay, and difference in components of equity is how much? Difference in components of equity is that 11. Is it? It's how much? It's 11. It's 11 million. It comes to how much? This is nothing but how difference is 143. It is nothing but it is the retained earnings. Fine. Are you clear about this? No, it's very simple. Is that we have to be very structurally. If we work it out, it makes real sense as well. Is that next? In the same way, is that you put one dash here. Yeah, it is still in working note. Is that we are talking in terms of what? We are talking in terms of captive. Is it right? We are taking into concerns of the captive as such. Captive. Same thing. Okay. Particulars particulars at the date of acquisition date, and reporting date. Yeah, how much is the share capital? At the date of acquisition, is right? Share capital at the date of acquisition. Share capital is how much it is given. It is given 390. Okay, 390. Here will be also 390. It is also 390. Is that you have retained earnings? Is that we have retained earnings? How much it is given in point number 2? Okay, point number 2. How much is the retained earnings? And the transfer of non-depreciated consideration is 541, 441.77. Here they have given the retained earnings. How much is the retained earnings? Retained earnings are 90 million. Okay. Other components of equity is how much? 24 million. Is it right? Other components of equity how much? 24 million. Retained earnings is 90. Is it right? Other components is how much? Other components is 24. Is it right? Other component is 24. How much they gave the net assets of the cap to? They say that the difference, that the excess in fair value, is it right? The excess in fair value is due to, is it? What is the fair value? Fair value is how much? Fair value is 526. Is it right? Fair value is how much? 526 million. Difference, balancing figure. Is it right? Excess. Is it? It is nothing but the land. Is it right? How much is there? See the thing. I'm writing a 526 minus 390 minus 90 minus 24. Is it right? It comes to how much? 22. With respect to the reporting date, you have to check the, you have to refer the balance sheet given in that. Is it 390, 169, 45. Okay, 390, 169, 45, and this will be carried forward in the same way. 22. Is right? If you do the total, how much you will get? 9 plus 5, 14, 2 plus 2, 16, 1, 10, 16, 20, 22, 1, 1. It is like 5, 3, 4, 15, 3, 4, 5, 6. What we have done previously, we will follow the same way. Is it? Net assets movement. Is it? Net asset movement. Is it? Net asset movement. How much is there as on reporting date? As on reporting date is how much? 626. As on acquisition date is 526. Difference is how much? Difference is 100 million. Is it right? Difference is 100 million. And with respect to the other components of equity, other components of equity, is that reporting date? Is that reporting date is how much? Reporting date is 45. Reporting date is 45. Acquisition date is how much? Acquisition date is 24. Difference is how much? 21 million. Is it right? Difference is 21 million. Now, is that difference is how much? What is the difference between net assets and components? Is it the difference between net assets? Is it right? Net assets movement. Is it right? And other components of equity. Is that other components of equity? How much is nothing but the retained earnings? Is right? It's nothing but the retained earnings. 100 million minus 21 million. It comes to 79 million. Is it right? This is nothing but retained earnings. Is the remaining balance here? Okay, just you put it. Yeah, this is the for working note 1. In the working note 1, what we have done, we have calculated the retained earnings. We have calculated the net assets movement, difference in the component of equity, and the balancing value is the retained earnings, both for the data and for the captive company. Is it right? Next one. This is note 3. Okay, note 3. Note 3 is related to goodwill. Here, when we are doing the goodwill, simultaneously we have to do the goodwill for the both the companies, and we have to calculate the impairment also. Is it right? We have to calculate the impairment so that we can know what is the goodwill on the reporting date. Is it right? Now, how much the purchase consideration, fair value of purchase consideration. Take point number 1. Okay, the purchase consideration is how much? 600 million. Okay, the purchase consideration is how much? 600 million. Right? The purchase consideration is 600 million. What is the fair value of NCI? Fair value of NCI is 395 million. Same steps, and you have to deduct the fair value of identifiable net assets. Is it right? Fair value of identified net assets. How much fair value of identified net assets? 935 million. Everything is given here only. Is it right? Everything. Minus, you have to deduct the, we have to identify the impairment. Okay, first thing what we are taking into consideration related to data. I will do the calculation side by side. Okay, this is with respect to the goodwill and what is the impairment also. Okay, this is related to point number 1. Wherever is possible, I will show you the thing. Right? A fair value of consideration. Fair value of consideration at the rate of how much? 60% interest. Is it right? 60. How much is the fair value of consideration? It is in millions. It comes to how much? 600. Is it right? Add. Is it right? Fair value of NCI. Is it right? Fair value of NCI. How much? Again, see that thing. Don't get confused. Is it right? All this has been given way. All this has been given in point number 1. Okay, all this has been given in point. What is the fair value of NCI? Fair value of NCI is 397 minus. Is it minus? Is it fair value of identifiable net assets? Is it identifiable net assets? Is it right? How much is there? This is given in point number 1. It is how much? 935. Is it right? If you take this into 695, 600 plus 3, 995. 995 minus 935, how much will come? It will get at this. This is called as goodwill at acquisition. Is it? This is our goodwill as acquisition. From this, we have to deduct less impairment. Immediately now only we will do. Is it right? Impairment of goodwill. Again, we should not go back and again will not wait. Is it right? Here I am writing here impairment. Is it right? Impairment of goodwill. Is it impairment of goodwill with respect to what? With respect to the data. Is it with respect to the data as such? It will be easy for us to make sure that how it will done. Is it right? Now, how we have to do impairment of goodwill? Is it how we have to put separately? Okay, put separately. We have calculated goodwill. Is it right? We have calculated goodwill. Is it right? Note 3. Is it note 3? How much is goodwill? We have calculated goodwill is how much? Goodwill at acquisition. Is it right? Goodwill at acquisition. How much? 60. Is it right? You have identifiable assets. Is it? You have identifiable net assets. Is it right? You have identifiable net assets. We have done this in working note 2. Is it right? Working note 2. How much is that? 1089. Is right? 1089. If you take the total, it comes to 9411. Is that 9411? This is the total. Is right? This is the total. From this, what you have to, how much we are going to recoverable amount? How much we are going to recoverable amount? It is given in point number 3. Is it right? Point number 3. How much they have given in point number 3? Recoverable amount of data is about 1099. Right? Recoverable amount of data is about 1. See, you do one question with all the focus things will be easy. Is it 1099? Is it the total is this much? The recoverable amount is less. Is it right? How much you will get? It is the decrease. Is right? This is known as impairment of goodwill. Any doubts are there? Anything is there? Just you make sure that you write it in a comment box. I will get back to you with this. Okay. Now impairment of goodwill is how much? This is where we have to show here. Yeah, just I am putting here like this. Is that impairment of goodwill is how much? 50. Is that right? Impairment of goodwill impairment is how much? 50. Is it right? Now, when goodwill impairment is 50, is that what is there? How much the difference? The difference is there. This is nothing but goodwill at reporting date. It's very, see, that is the reason you do the things side by side. You will have very clarity on the subject what we are doing. Okay. Now, in the same way, it is right. We are talking in terms of what we are taking in terms of captive. Okay, captive. Same concept is right. Fair value of consideration, fair value of purchase consideration is right. Fair value of purchase consideration. How much is it? This is they have given in way. This they have given in point number 2. Be very clear. Okay. Point number 2. Fair value of consideration is how much? 541. Is right. Next, NCI at acquisition. Is it NCI at acquisition? Acquisition. Is it right? NCI at acquisition. Now here we have to be little bit careful. Okay. In point number 2, that the date of acquisition, the identified assets of Cap 2 has a fair value of 526. Is that 526? Retained earnings are how much? Retained earnings. Because we are using which one? We are using the here in the second case. Which method we are using? That's we have to be very careful. Is it right? In the first method we are using full goodwill method. In the second case we are using partial goodwill method. In the partial goodwill method we will take the share of the parent company only. Is it right? We take the share of the parent company only. Fine. NCI at acquisition. How much is there? NCI at acquisition is 526. Is it right? Into times 20%. Is it right? How much is there? 105.2. Is it 105. Next, what is the what less Is there's fair value of identifiable net assets of the subsidiary. Is it right? It is given how much? 526. Okay, 526. How much you will get if you take that into consideration? You take into consideration how much? 541 plus 105 minus 526. It comes to 120.2. Is right? This is the goodwill. This is the goodwill for 80% share. This is the partial goodwill. Is it right? Partial goodwill method. In the partial goodwill method, we have to take only the parent company. This is very, very important. Is it right? Is it? No. Subsequently, what we have to do? We have to take the impairment. Okay, we have to consider the impairment. Here side by side, we will do the impairment also. Is it right? You put one dash here. Is it? You put one dash here. Impairment. With respect to whom? With respect to captive. Is that impairment with respect to what? Captive. How much is the goodwill? Say goodwill of 80%. Is right? Put one here. Goodwill. See, is it? Goodwill is how much? 120.2. Is it right? This is for goodwill at 80%. Is it right? Now, what is the NCI if for 80%? Is it right? So I am writing here only for 80%. Goodwill is how much? 120.2. Okay. For 20%, question mark. Okay. 20 by 80 times 120.2. It comes to how much? It comes to 30.1. Is that means? See, is that now you are understanding what is the partial goodwill method? Is that what is the partial goodwill method? Means first we have to take for 80%, then we have to take. We should not just think about that only the one. At later stage we have to add. Is that how much is there? 150.3. Okay, this is called as total notional goodwill. Is that total notional goodwill? Now, how much is the identifiable net assets we have done here? Is it minus? Is it identifiable net assets? Is it? Sorry, it is plus. Is it identifiable net assets? Is it right? Net assets. Working note 2. Is it right? Working note 2. How much we have done? 626. Is it right? Total assets will be how much? Total assets will be 0.366776.3. Is right? This is the total one. Right? From this recoverable amount. Is right? Recoverable amount. We have to record 776. But how much we have going to recover? This is from where we are getting it. Point number 3. If I say point number 3 means you have to refer question. Okay. Point number 3. How much is the recoverable amount? 700. Is that? Now, if we take that one into consideration, how much is there? 76.3. Is it right? This is nothing but impairment. From this impairment, we have to, is it from this for 76.3. Is it 76.3 is the impairment. Fine. Impairment. This is for 76.3 is impairment for how much? Is it 76.3? 76.3 is the 100%. Is it right? It is the 100% impairment. Fine. Now, in this, we cannot take 100%. Is that we have to take partial goodwill method. In the partial goodwill method, we have to take only 80% of the share. Is it right? Less impairment only at 80%. Is it right? 76.3 into 0.80 it comes to how much? It comes to 61 almost. Is that right? How much is the goodwill? Goodwill is how much? 2. Is it right? Goodwill is how much? 2 point. It comes to how much? 9, 9 and 59. Is it right? 59. This is the goodwill at reporting date. Goodwill at reporting date. Now total goodwill is how much? 10 plus, is it right? Total goodwill. I'm writing here. Is it right? Total goodwill. Total goodwill is how much? Total goodwill is 10 plus 59.2. It comes to 69.2. $69.2 million is the total. Fine. This is the total. Now, okay. We should have next. What they say? They say that in the point number 2, is it right? In the point number in the point number 1, their carrying amount of land is how much? 56 million. They have included in the sale. They sold it for. They transferred it for 64 million. The carrying amount is 56 million. It has been still included. Point number 2, land. Okay. Point number 2, land. Is it right? It is not. It is part of the same working note. Is it right? How much is that the consideration is how much? Consideration is 64 million. Fine. Consideration is 64 million. Carrying amount is how much? Carrying amount is 50. Carrying amount is how much? 56 million. Is it right? How much is the profit? Profit is we are not concerned about profit right now. Okay, we are talking about the reversal. Is it? We have to do reversal. Is it right? We have to do reversal. Reversal is nothing but we have to exclude it. Is it? We have to exclude it. What is the debit entry and what is debit and credits? Is it right? If you want to exclude it, it is an asset. Is it right? Asset. If you want to decrease the asset has to be on the credit side. And if you want to reduce the profit, it has to be on the debit side. We will not use profit and loss account. We will see retained earnings. Is it? Retained earnings. It is how much? Retained earnings is 56. The value of the carrying amount. Okay. Property, plant, and equipment is how much? Credit is 56 million. Is it? We have to show this. Is it? We have to show this. Is it? To arrive at the gain. Okay. We have to show this. Arrive at the gain. Okay. This is the part working note 3. Okay. This is working note 3. Next, what is the working note 4? Working note 4. I'm a little bit slow here, but it makes sense. Is it right? We are talking in terms of NCI. Okay. We are taking into consideration non-controlling interest. Fine. Now, NCI in date of acquisition. Point number 1. Is it right? NCI at the date of acquisition. Is it? 1 minute. NCI. NCI related to what? Related to data. Is it? NCI related to data company at acquisition date. Is it? At acquisition date. How much is there? See the point 1. Okay. Point 1. Is that acquisition date? How much is there? 395. Okay. Next. Now NCI is that NCI percentage of post acquisition profit. Data post acquisition of net assets. Is that post acquisition of net assets? Is that how much is the we have calculated somewhere in where I will give that reference. Okay, we have calculated in terms of different net assets movements. Is it right? Net assets movement 154 million. Is it right? Is it net assets? I'll put net assets movement as in a small one. Net assets movement. Is it right? Net assets movement 154. Is it right? 154 at the times 0.40. Is that 0.40? It comes to how much? 61.6. Is it right? Next. What happened is that on November, at the date, they have increased. Parent company increased the share from 60% to 80%. One side parent company share will increase and another side the NCI share will decrease. Okay, NCI share will decrease. That we have to be very clear. It is a next. In that case, what you have to do? Minus reduction. Is it right? Reduction in NCI. Is it right? Reduction in NCI. I'm putting here. Is it? I'm just reduction in NCI. Okay, of what? Of data. Is it right? Reduction in NCI of what? In terms of data. I'm not using a separate note on that. Immediately I will write side by side. Okay, I will write side by side. Now, reduction in the how much they have purchased 20 additional 20% share. Is it right? Fair value. Is that fair value consideration? Fair value consideration for additional. Is it right? For additional 20%. How much is there? It has been given where? In where it has been given? It has been given. It has been given in point number 1. Is it right? It has been given point number 1. Is it? It has been given in point number 1. Okay, it has been given in the point number 1 very specifically. Is it right? I am highlighting the things. Is it? How much is there? It is how much? 220 million. Okay, it is in 220 million. It is in dollars in millions. Fine. Net. NCI, the date of acquisition is how much? NCI at the first one. Is right? NCI at acquisition. Is right? On in the first one. Is right? In the at the beginning. Okay, at the beginning, how much they have? It is how much? It is 395. Is it right? It is 395. What is the NCI? What is the NCI share? Is it right? In net assets movement. That's very important. What is the NCI? The net assets movement. How much is the net assets are there? Net assets movement is 154 into how much? Into 0.40%. Is it right? It comes to 61.6. It comes to how much? 61.6. Total is how much? Total NCI at acquisition is 395. 61.6. It comes to 456.6. Is right? Yeah, this is the NCI. Is that? This is the NCI per share. Is that NCI per share purchase? Now see the thing. Is that? Now see the thing. This is for what? This is for 40%. Is that? At 40%. We have to see now NCI is reducing 20%. Is it right? NCI is going to be this is for 40%, 456. Is that for 40%? For 40% 20%, how much? 456.6 for 20% question mark. Is it right? For 20 by 40 into 456.6, is it? Into 456.6, it comes to how much? 228.3. Is it? 228.3. This is the share at for 20%. Is it? This is the share for 20%. Now, what is the fair value? Is 220. What is the NCI? 228. Again, is it right? There is a increase. Is it right? There is a increase. How much is the increase? 8.3. Is it right? This is the positive movement in equity. How much? 8 point. Means we are calculating two things here. Is right? We are taking into consideration the reduction in NCI, and as well as we are taking into consideration the amount that has been positive movement in the equity asset. Reduction in NCI is how much? Reduction in NCI is 228. Is it 228.3? Why it is reduction? Because the parent company share increased from 60 to 80, and the naturally the subsidiary company share will it has been decreased from 40 to 20%. Is it right? Next, there is a impairment of goodwill also is there. We have calculated. Is it right? Impairment of goodwill. How much is the impairment of goodwill of data? Is it right? Where we have done? We have done in working note 3. Is it right? We have done in working note 3. How much is there? 10. Okay. Next. Now we will take into the captive. Okay. We will take into consideration the captive. This is related to whom? This is related to the data. Okay. This is related to captive. NCI, how much is the NCI cap to at acquisition? Is it? At acquisition is how much? 105.2. Okay. Where it is given? Point number 2. Is it right? We have calculated somewhere. We have calculated. Yeah. 560 into 20%. Okay. 560. I'll write here. Is it? 560 into 0.2. Is right? Next, how much is the positive movement of assets? Positive movement of assets are 100 million. Is it right? Positive movements are assets. How much? Add. Is it right? NCI percentage of post acquisition. Is it right? Post acquisition net assets. It's nothing but positive movement. Okay. It is nothing but the positive movement. How much is there? It is 100 million. Is it right? It is 100 million times 20. Okay, times 20. It comes to how much? It comes to 20. Is it right? If you add all the things into consideration, you will say that it is the non-controlling interest. Is it right? Non-controlling interest. How much is the non-controlling interest? If you put, it comes to how much? 343.5. This is related to the next. Now, what we'll do next? We calculate the retained earnings. Is that working note 5. Is that working note 5? Reserves in terms of retained earnings. Now it's almost simple, is it? Only thing is we have to board. Now, how much is the traveler? What is the it has been given traveler is how much? 1066. Is it? It is given in the question. Is it? It is given in the question. How much is the traveler? 1066. Is it? It is given here 1066. Is it right? In 1066. Whatever we have done now, whatever we have done, we have to take those things into consideration. Now from this, what we have to do? We have debited retained earnings with respect to sale of asset. Is it right? With respect to sale of non-current assets, how much we have debited? Retained earnings, we have debited 56. Is it? We have next. We have done impairment of goodwill. Is it right? Impairment of goodwill. Is it right? Impairment of goodwill. We have done for data is how much? Impairment is how much? Impairment of goodwill how much? It is 50 million. Is it right? 50 million into 80%. Is it right? 50 million into 80%. We'll take only parent company share. Is it right? Captive. Is it right? Captive, how much is the impairment of goodwill? 76.3 into 0.8. Okay, 0.8. It comes to how much? It comes to 61. Is that? This is the impairment. Is that? This is the impairment. Fine. Next, you have post acquisition. Is that? Post acquisition retainer. We have calculated in working note 2. Is it right? Post acquisition retained earnings in working note 2. Is it? Post acquisition in working note 2. How much we have calculated? 143 and 79. Okay, 143 and 79. Is it? Data is how much? Data 143 into what is the percentage? 0.6. Is it? 0.6. How much? 85.8. Is it? Captive. Is it right? How much is the captive? 79 into 0.8. It comes to how much? 63.2. If you take the total, right? If you take the total, it comes to how much? It comes to around this is the total of retained earnings. Is it a total of retained earnings? And we have to take the other components of equity. Is it? How much is the other components of as per in the traveler? Is it? Other components of equity is how much? 60 million. Is it right? 60 million. Next, how much is the for the data? Is it right? For the data, how much is the difference we got it? We got 11 million. Is it right? 11 million into 60%. Is it right? 11 million into 60%. 6.6. Is it right? For the captive. Is it? For the captive, how much? 21 million into 0.80. 80%. Is it right? 16.8. Is that we have done positive movement in equity. Is that positive movement in equity? How much positive movement in equity? Positive movement in equity is how much? 8.3. Where we have done 8.3 in the just in the working note 4. Okay, in the working note 4. In the note 4. Is it? If you put that all the things into consideration, 60 plus 6 plus 8.3. Is that 60 plus 6 in 60 plus 6.6 plus 16.8, 8.3, it comes to how much? 19.7. Done. That's all. Is it right? Is it? That's all. Right. Very, very specific. Is it right? This is working note 5. Is it right? This is the other component of equity. This amount we are going to, this values we are going to show in the consolidated financial statement. This is the total of retained earnings. Last one we don't need, but fine, it is better. Is it right? Note 6. Note 6. We will do it. Is it right? Actually, it is not needed. We can do it directly in the balance sheet, but fine. Is it right? Property, plant and equipment, traveler. Is it right? How much for traveler? 439. Is it right? Okay. What is the property and plant data is how much? 810 given in the question. Is it right? What is with respect to captive? Captive is with respect to 620. Is it right? Next, increase in value. Is it right? Increase in of data. Is it right? Increase in land. How much? The value is how much? 10. Is it right? Increase in data of what in terms of captive? Is it right? Captive, how much is there? We have calculated 22. Is that minus we have disposal of asset. Is it? Disposal of asset. Is that how much we have said disposal? Disposal is 56. 439, 9 plus 2, 11 minus 6, 5, 4 plus 1, 5, 7, 10. It comes to 4 plus 8, 12, 6. It comes to how much? It comes to 8. This is the total property plant. That's all. Is it right? It's so simple, so easy to understand and to make sure that how things are processed. Now we have done all the workings. Is it? We have done all the workings. We don't need anything else. Is it? We don't need anything else. The next part is we are talking in terms of what? We are talking in terms of consolidated financial statements. Here only I will do, okay? Consolidated statement of financial position. At 30th November 2010. Okay. Particulars. You have no, we don't have anything. Is it amount? Is it dollar in millions? Okay. Next, assets. Is it a non-current assets? Okay. We have done property, plant and equipment. Is it note 6? Is it note 6? How much is the property, plant, equipment? 1845. Is it? We have done goodwill. Is it? We have done goodwill. Actually, goodwill has to be written in the beginning. Okay. Goodwill. How much is the goodwill? We have done 69.2. Okay. Where is the goodwill? Where we have done goodwill? Yeah. In working note 3. Okay. In working note 3. Note 3. Fine. You have the financial assets. Is it? We have the financial assets. Is it? We will take all the financial assets. Is that how much is there? 108 plus 10 plus 10 plus 20. Okay, it has been given in the question, is it right? It has been given in the question how much is the financial assets. Financial assets are 108, 10 and 20. We are not doing anything on that. We don't need, okay, we don't need any adjustments on that. It comes to how much? It comes to 138. Is it? You have the current assets. Even current assets we are not having any adjustments. 1067 plus 781 plus 350. It comes to how much? It comes to 2198. Okay, if we take the total 404250.2, these are the total assets. Fine. Total asset. I'm taking that gap into, is it right? I'm taking that gap into consideration. We have equity and liabilities, is it? We have equity and liabilities, is it right? How much is that? We are taking only the parent one, okay? Equity, is it right? Equity is only to the parent, is it right? Only to the traveler, okay? Only to the traveler. How much? 1120, is that? You have done retained earnings, is that? Retained earnings. We have calculated retained earnings. How much? Retained earnings 1058, is it? 1058. And we have other components of equity. Other components of equity. See, this consolidation is not that much. You see, they will, once your workings are perfect, consolidation is just, we can do, it's a piece of cake, okay? Other components of equity 91.7. Okay, other components of equity is how much? None. We have, is it? Now you put it here. How much? It comes to how much? It comes to 269.7. I'm writing here, okay? NCI, is it right? Total NCI we have done, is it right? How much is the NCI we have done? I will just give the reference, okay? Where is that NCI? Yes, NCI is working note 4, okay? NCI is where we are talking about working note, working 4, is it right? NCI is how much? 343.5, okay? Next, right? You put it, how much you'll get? You are getting how much? 22613.2. Okay. We have non-current liabilities, is it? Non-current liabilities are how much? 455 plus 323 plus 73. Is it right? It comes to how much? 851. Okay. You have current liabilities, is it? You have current liabilities 274 plus 199 plus 313. Okay, it comes to how much? 786. If you put all the things, is it right? Just I'm doing all the things. Yeah, you can put it separately, but fine. Is it? This is A. Is it right? 851. How much will get? 7316. It is B, is it right? It is, this is total equity, it is total liabilities, is it right? Total liabilities, total equity and liabilities, A plus B, okay? A plus B, how much will get? We'll get 4250.2. Is it? 4250.2. Are you clear about this? Is it? This is a very simple one, basic one. When we are coming for the next sessions, next videos, I will make it. See, it's very See, we have to think about partial goodwill, we have to think about the full goodwill, and we have to think a partial goodwill we have to convert into a full goodwill for the captive. Then we have to take into consideration what then we have to take into consideration what we have to take into consideration the once we have converted into 100%, then we have to be in back to 80% and 20%. Is right? This is the most specific one with respect to this question. Is right? Means we have to be very clear about IFRS 3 business combinations, partial goodwill, and full goodwill method. That it's easy. It's not difficult asset. Wow, okay, fine. What they are talking, what they are talking in terms of the second one, part B. Yeah, this is for 30 marks. Is it right? This is for 30 marks. Next, yeah, 7 marks. This is also, see, theoretical concept you have to be very clear. What they say, I have put the answer on the right hand side, and just I will make it a point that it makes things at the end of the year. At the end of the year, 30th November, is it right? At the start of the year, 30th November 2002, traveler acquired major subsidiary inventory acquired in this business combination. Value at fair value, is it right? At acquisition, in accordance with IFRS. See, what is the rule of inventory valuation? Is it right? What is the rule of inventory valuation? The rule of IAS 2, we have to be very specific. Is it right? We have to be very, what IAS 2 talks about, what IAS presentation, what IAS 1 talks about. Is it right? We have to make very specific on that issue. The inventory increase in a value is a result of fair value exercise. A significant part is acquired and sold shortly after. There was a transactions happen. In the consolidated statement of profit and loss account and OCI, other comprehensive income, they intend to split the cost of inventory. They want to separate it, and in the business combination, and sold how much they have sold by the acquirer after the combination. Is it right? On two different lines. One is on the one is based on the cost of sales, and one is based on non-recurring item. Means once you have been sold, we should make it a point that after acquisition and before acquisition, we have to make a line very clearly, the differentiation. The part presented on the cost of sales will have the carrying amount in the subsidiary financial statement. This is all about now presentation. Is it? The simple basic concept of presentation. They are not asking anything advanced. Okay? This part is present. One part is presented as a non-recurring item. See, these are now when we do the things. Whenever there is a acquisition, is it right? Again, before acquisition, you are doing separately. But once it is an acquisition, it is not going to be. It is all be under the consideration of a parent company. Okay. The part presented is as a non-correspondence to the fair value increase. How much is there? What they say that it's a really a material amount. Is it at 25% of the traveler's EBIT? What is the accounting policy? The moment when they say accounting policy, is it accounting? The moment we say accounting policy, we have to refer it as a IAS 1. Is it right? Explain that they are showing the full fair value of the inventory within the cost. Actually, that is not the case. Is it right? Actually, see, they have the, see, if you go to the question, what they have done, they have sold an asset, but they have not excluded the asset. Still the asset is there in the balance sheet. Is it right? Means they have acquisition, all those process as such, but subsequently what happened, they have to treat that at that date, okay, we have to separate it as on that date, so that again it should not correspondent it, and you should not have a double two times. We should not, either we should not show it again, okay. In the notes to the financial in the what they said, intends to disclose the accounting policy in the financial state. Intends, is it showing full fair value within the cost of sales, and would result in the fall in the, definitely if you are showing that full value, what will happen? The cost of sales will increase, the gross profit will decrease, is right? And what the parent company arguing that this part of margin is a non-recurring item. Fine. How will it enables to evaluate the gross? See, definitely if you are showing it in the cost of sales, the cost of sales will increase, the gross profit will decrease, is it? Now what they said, IES 2, we have to mention the standards, is that the carrying amount of inventory sold recognized as a expense, as simple as that, is it right? As simple as it should be recognized as expense. Cost of sales or cost previously included in the inventory have now been sold plus unallocated expenses, is it? Once it has been sold, you have to keep it up separately. See that how many standards we are referring? We are referring IAS 2 with respect to inventory. We are talking about IFRS 3 with respect to the business combination. IAS 1 with respect to the presentation of financial statements. Is it right? IAS 2 in terms of business combination. What is the rule? What is the condition? That requires an acquirer to measure the assets at the fair value on the date of acquisition. This is what we are doing all through the time. Is it right? This is what we are doing all through the time. We are taking the fair value. Is it right? With respect to the cost of sale. Presentation also. In the presentation also, what we are doing, we are talking about what is the set of minimum levels of financial statements. Is it? With respect to the disclosures. What IAS 1 talks about is that it says that it should be presented a level of it has to be presented in a very, very specific way, is it right? And based on that disclosure, there should be some understanding and judgment, decisions can be taken. Is it right? That is the basic content with respect to the qualitative characteristics. Is it right? Qualitative characteristics. Whenever we are talking about the thing, it should be relevant. It should be relevant. It should be where it is there. It should be relevant. It should be reliable. It should be comparable, and it should be understandable. These are the qualitative characteristics. Is it? Based on the elements of financial performance? Is it as per the whether it is going to it is going to have impact on the profits, it will have impact on the expenses, it will have impact on the assets, and subsequently all the. That is what the concept, what they say, what is the conclusion. Just go through it. Is right? However, the practice of presenting non-current recurring and may be interpreted as a way to present it as extraordinary item. Is right? Means what they say, the fact that extraordinary items are not allowed under IAS, it can be argued that you can put it in additional lines and totals as permitted by IAS 1. Means as simple as that. Whenever the purpose of qualitative characteristics is, it should not be more complex. Is right? It should be simple, and it should be very easy, that so that the stakeholders, it is for external purpose, isn't it? For stakeholders should understand. What they are saying to conclude, the cost of inventory should be presented as a cost of sales and should not be split as per the traveler. Fine. This is the basic concepts with respect to the consolidation of financial statements of traveler, data and captive, and a presentation of how we have to reflect the inventory, whether we should split it or we should not split it. Is it right? Is it? This is the one. Okay. If hopefully you understand this concept and this solution, anything, any doubts are there, you can put it in the comment section, and just subscribe this channel, and I will come up with new videos on SBR till the examination. Okay. Thank you so much.